Good day and welcome to our week 2 video. On week 2 is what we'll be dealing with. Let's look here quickly. We'll be dealing with liquidity. And the topic there's how many liquidity types do we have in the market, and how do we use liquidity, and how do we avoid to be liquidity. All right. So now let's go to our PDF quickly. Let's go to our PDF quickly. All right, our PDF on liquidity. It's on week number 2. Yeah, page 7. Liquidity, and number 1 is how many types of liquidity do we have in the market. The answer is we have buy stop liquidity, sell stop liquidity, trendline liquidity, imbalanced liquidity, equal low liquidity, equal high liquidity, and inducement liquidity. Right. So now, what is a buy stop liquidity? Buy stop liquidity, this is when you place your buy order, market goes to your direction, then suddenly reverses to take your stop loss, then continue to buy. Why does this happen? This happens because you hijack the market in the middle of nowhere and you haven't checked where price is coming from, if there's any other form of liquidity as stated above. Right. So now another kind of liquidity, sell stop liquidity. What is it? The same description is about, just differ with a sell because the previous one is buy. Alright, so you don't have to dwell much on that. So now the trend line, the trend line liquidity, or before we get to the trend line liquidity, let's deal with this buy stop liquidity. Now this is how that buy stop liquidity works. Let me see if I can get let me see if I can get an example here. Let me see if I can get an example here. This thing happens usually in a fail of market structure in a continuous trend, right? All right, here I have a sell stop liquidity. This is not a buy stop liquidity. What do we see? We see this failure of market structure here. Why is this a failure of market structure? Because this low broke this low here, right? So this is a failure of market structure. So now when you see this, you are definitely sure that you're gonna sell where? Here in this candle here. So what does the market makers do? Now they push. Now, okay, your sell is active here, and sure, it's good, you are in profit here. Then what do? They reverse the market. Obviously your stop loss is somewhere above here, right, or just a little bit here. So now somewhere here, your stop loss. So now they push the market back to what? Back to fill the imbalances, this liquidity here that you are not aware of. You just hijacked the market. You set your sell limit here, and then look at what happens. They fill this imbalance, and then they do what? Then they reverse into a direction. So now if you get in here for a buy, if you get in here for a buy, then your stop loss is likely to be somewhere down here. But look, then again, when they reverse after they filled this imbalance all the way to here, look at what they do. And they push the market further down to your direction of sell. So this is sell stop liquidity. There's no magic on it. There's nothing much I can explain with it. So now the trendline liquidity. This happens always either bullish or bearish. After a formation of order block, look at the swing lows or swing highs before the mitigation of the same order block. If you join those swings with a trend line before mitigating that order block, then know in that time frame where you are, there is a trend line liquidity, and it will be taken out by the next move. Okay. So what do I mean by that? Here's an example of a trend line liquidity here. We have a break of market structure here, a clear break of market structure here. Okay, I'm not sure if you'll see my cursor, so let me just use this one. You see a clear break of market structure here. Okay, so now we have this first swing low here, we have the second one here, and then we used the deep one. So we joined from here to this all the way to here. So what do we have here? We have liquidity resting where below this trend line. So what is that? That is our trend line liquidity. So if you're a retail trader, you know that this is a first touch. um, you are now aware that this is a first touch, second touch, and then a third touch here you are supposed to buy. But look at what happened. As I said, there's liquidity resting below this trend line. So what did they do? They pushed the market further down to clear all the liquidity here, and then they came to this bullish base order block. But why this bullish base order block? Simply because there was another liquidity in the form of imbalance here. They had to balance the price, and then this is our order block, and then now they're pushing the price back. Simple as that. That is our trend line liquidity. All right. I hope you understand that. Then we have imbalanced liquidity. What is imbalanced liquidity? This is when the wick or body of a closing candle does not touch the wick or body of the opening candle. The gap thereof is the imbalanced market, and I always know that it will be filled either immediately or later, but it will be filled irrespective of time frame. Now let's go to the live chart. A perfect example here. This close of this week did not touch this opening of this um, new candle. So this gap in between here, is what? It's an imbalance. So look now what happened here. After after they push price to break structure here, look at what happened. Now they filled this imbalance all the way to here with this week here. So now after filling this, and then your entry will be where this bearish candle closes. This is the closing of bearish candle. However, this is the opening of bullish candle. They're in the same position, but they mean different things. Okay, so this is a closing of the bearish candle. So it was our entry here, because now the market is balanced, so hence now they're pushing it further down. That is an imbalance. I think I've seen some people saying an imbalance is something it's something like this. Yeah, I think I've seen something like this before, saying that from this week here all the way to here, it's an imbalance. So I was asking myself, if you say this is an imbalance, what do you say about this week then? What do you say about this week? But again, I realize that those people are not aware of how to trade weeks. They don't know yet how to trade weeks. But you are lucky you are here. In fact, you are fortunate enough to be here, and I'm fortunate enough to have discovered the power of the weeks. So now we'll deal with that later on. So now I wanted to show you exactly how to mark your imbalance. And then again here, the imbalance is from this candle this week, I mean, all the way to here. So now you must know that this gap will be filled. As you see on the right here, this gap has been filled, and then this candle was our point of interest. And then if we do not sell, what do? We buy. And then what is this now? It's a breaker block. So what do you do now? This is what we now see. So this candle took out the liquidity above our order block here. So instead of us selling here, what do we have to do? We have to buy. Hence you see this bullish move. As simple as that. Right, that's an imbalance. So Now let's go to page 8. It says equal low liquidity. What is equal low liquidity? This is what retail traders refer to as double bottom. Usually, when people see an equal low, they take their buy orders, right? Some with and some without other confluences. However, always know that when you see an equal low, there is a bullish order block that must be mitigated. Therefore, that equal low is just a trap. Also, equal lows most of the times are after an imbalance. So now let's go to that double bottom, uh, to that which you refer to as a double bottom, which is an equal low. Let's see, is this an equal low? No, this is not an equal low. Is this an equal low? No, it is not. Is this an equal low? No, it is not. Okay, here's another mistake. While I'm looking for a perfect equal low, some traders, they mark something like this from the wick. Okay, this is the wick to the body here. And then they say this is an equal low. Honestly, this is not an equal low. I think we understand the word equal. Those things must be at the same position and have the same length. Simple as that. That's an equal. That's something equal, right? So now I'm looking for a perfect equal low, and then when you see that, we'll definitely look for another block. Oh yeah, yeah. Do you have one here? No, we don't have one. Let's look this side. We have one? No, we don't have one. And then here, no, we don't have one. And then another thing, when you look for an equal low, you always start on your left. This lesson was given on YouTube. I don't know how many people benefited from it. But the thing is, whenever you look for an equal low, always start on the left. This is a left to right. All right. This is how to look for your equal low. As I continue to look for the perfect one, I did not mark this prior to the recording. Then things would have been easy if it was like that. Everything would have been easy if it was like that, but I did not. Okay, yeah, I think I found one here. This equal low here. All right, this is an equal low here. So this is another type of liquidity. Whenever you see such things happen, you must always know that there's an order block, there's a bullish order block on the left that needs to be mitigated. All right. So now let's look at this. Where's the other block? Okay, it seems to be far. Now let's look at one. Let's look at one more example with an equal low. Yeah, another one is here. You see an equal low here. All right, this is the 1, 2, 3, 4. Yeah, net 4. So now there is another block on the left that needs to be mitigated. And then I can. Right, let's go to higher time frames. I think we might find something there. Let's go to higher time frames. Um, Still I can't find it. Then here, no, it is not equal low, and here it is not equal low, and then here it is not an equal low. Okay. Let me go back to the description. So we'll work with the description. It's a double bottom, as simple as that. Let's have this then. Yeah, let's have this. Now an equal low is something like this. This is our order block here, right? And then we see price came down here, and then it pushed up. What did it do? It broke structure here, right? And then the next move down, it come exactly to this low here. And then after that, what happens? Then they push the price further up, and then a little bit they break this structure. Now if things are like this, just know that down here there's there's liquidity that need to be taken. So you'll find out that this structure did something like this. There's a break, right? And then the, there's an order block down here. Oops. There's an order block down here. So now this is double bottom 1 2, and then you already bought, but you are ignoring this order block. You are ignoring this order block down here. So price, what the market makers will do, they'll push the price further down to take out the liquidity that's resting down here, to mitigate this order block, and then after that push the price up. This is what we mean by equal low liquidity. Do not trust this as a buy. This is just a trap, right? I think you got that. Now equal high liquidity, same as above description, just change low to high. Simple. Now inducement. Now this is where I see a lot of people chasing the market. They say we just missed by a few pips, we just missed by 5 pips, and if some chase the market, and then sometimes they panic. They ask themselves as to why were their orders were not mitigated. Well, that's inducement, my brother, my sister. And then what is that inducement? This is referred to most as a swing low or a swing high, right? Inducement appear always before order block mitigation. That swing is just to confuse impatient traders to take orders in a good direction, yes, but at the wrong time. Here's an example of that inducement. Now this is a break of market structure. This is a bullish base order block. Now this first swing low here. Now it's what? It's inducement. Why is this inducement? Because we're supposed to have this candle as a mitigating candle here. However, it gave us this swing low and then pushed the price far away. And then look also what they did here. They broke structure here. So now you have a low, you have a high, then you have a lower high, and then you have a higher high here. So now you are definitely sure now that you're going to take your buy here. Right, you are definitely sure that they're going to take your buy here. But remember, the original buy zone is here, this bullish base order block. This is the original buy zone here, this bullish base order block. Look at this week now, mitigated this order block, and then they changed. Simple as that. This is what inducement does. It entices you to jump in the market at the wrong time, right? So now let's look at an example of inducement on the live chart. Now this is stop hand. This is not the break of market structure. We'll deal with such things. The stop hand in the next chapter, and then let's look at that inducement. Okay, yeah. What do we have here? We have a break of market structure, a clear break of market structure. All right. where we're supposed to take our entry on the breaker block. We will cover the breaker blocks in the next in one of the chapters. Now this is the break. Okay, here we have an immediate retest, so this inducement does not apply here. I want another chapter where the inducement applies. Let's see now. Here also we have an immediate retest. It does not work here. We have an immediate retest. We can't find any. Oh, okay. Okay, I thought to find some, but no. I just want to show you something quickly. This here, no. I want a normal order block. I want a normal order block, not these breaker blocks. I don't want to confuse you. I want us to have a normal. Oh yeah. Now this is a break of market structure here. We're supposed to take our entry, our sell entry where? Here. In fact, here into this candle that caused that formed an imbalance, all right, and these huge volumes, right? So now this is a break of market structure. We're supposed to take our sell entry here, but look at what happened. Look at this candle. Now remember the definition of inducement. That swing is just to confuse impatient traders to take orders in a good direction. Yes, it's a good direction, but at the wrong time. So now let's come here. It's a sell here. The new sell candle opened here. So now when it gets to this, what do? You also sell the market here. But look then what happened. Now they're pushing the price up to take what the liquidity that they left here. There's liquidity above this candle here. So now they close this imbalance and then they mitigate this candle. And then now look at what happened after that. Look at what happened after that. This drop all the way to here. So this is just inducement. Do not hijack the market. I hope I'm making sense. Now, how do we use liquidity? This is the second chapter. We use liquidity to our advantage to get proper entries at the right time and at the right direction. This means that we wait for all these types of liquidity to be cleared, then we take our entry. Simple as that. Now wait for this inducement to be cleared, and then again we have remember the trendline liquidity here. So wait for all of them to be cleared, and then we take now our trades. Simple as that. We don't have to dwell much on this. How do we avoid being liquidity? We avoid being liquidity by not taking trades at the liquidity zone. Simple as that. And then what do I mean by that? This is a liquidity zone, this inducement here. Avoid to take trades in this candle here. Avoid to take a trade there, then you will not be part of liquidity. This was, I think this is the shortest chapter, and this is the end of it at less than 30 minutes. So my tip here is do not ignore liquidity at all. No matter how far price is, it will always come to sweep that spotted liquidity. Do not ignore that liquidity at all. No matter what, do not ignore it, because it plays a huge role. Right? It plays a huge role. Right? So So now we covered it. Just for a recap, buy stop liquidity, I just explained it, and then and, and then the sell stop liquidity, and then the buy stop liquidity as well, and then trendline liquidity, imbalanced liquidity, color liquidity, and equal high liquidity. As simple as that. I think this is the shortest chapter, and this is our week number 2. So to practice what you saw on week 1 combined with this, they will take you somewhere far in trading. Please practice these things, and when we meet on Zoom, and then please write down the questions, and then we'll deal with this. We'll dissect everything there. Alright, so this is the end of this chapter and this week. And then the next chapter will be all about week number 3, which is the entries. Now we were dealing with liquidity on week number 2. Have a good trading day and a good trading journey. Jabulo here.